Hi guys, it's Maynard. It's Tuesday and we're going to try it again. Let me kick off with today's participants, my co-host Mike Bradley, Colin Finton, and Matt Portillo. Those three will go first and we'll talk about the macro. Then we've also got Matthew Blair here from TPH Research. He does refining and chemicals, and he's going to talk about everything that's happening downstream. And we're particularly happy today to have Jason Wood of J. Wood Capital Advisors. If you noticed last week, EQT did a convert. There was another convert today, but the convert market is suddenly something very hot that we should talk about. And we'll round out today with a discussion with Bobby Tudor, our chairman, also chair of the Greater Houston Partnership, about what's going on in government circles as it relates to COVID. And he'll just fill us in on his perspective. So that'll be awesome. Welcome, everybody. Let's kick off. Mike Bradley, Colin, and Matt Portillo. Let's talk about the macro, oil and gas. Mike, why don't you kick us off? Tell us what's happening in oil.
Yeah, as most of you know, oil has just been terrible for the last couple weeks. And really, most of the focus has been on what's going on with the USO, what's going on with the June contract, what happened to the May contract. I think consensus is that the June contract is going to go off the board just as bad as the May contract. And so what you're seeing is USO and actually yesterday, Dow Jones and S&P, some of their ETFs, they announced that they're going to be moving out of the June contract. So put a lot of pressure on June contract. They're probably out now. And so we ended the day in the June contract being pretty flattish. The only reason I mention this is because, the July contract looks better. And I'd say the status of the market right now from a crude oil standpoint looks firmer. You're seeing U.S. production is really dropping off the map at this point in time. We're going to talk about that in a second through the natural gas numbers. And you're seeing some of these regional diffs like Midland, MEH, LLS are firmer right now. And the cash market, when you talk to commodity guys, is a little bit better than it has been over the last couple of weeks. So I'd say that, from a production standpoint, it's coming down rapidly. Demand has already basically hit the bottom. It's inflecting marginally higher. And I think everyone's concerned about what June's going to look like. That's kind of a game that's being played right now. But I think the bottom line is markets look firmer right now. That doesn't mean we're going to go to $30. It means that we're probably not going to really crash a July contract. And like I said, consensus is things are really bad, but it does look better.
So, Mike, your take on this is all the news about people in the June contract, all the noise with the financial speculation and such. It is dominating the headlines,
right.
But we're missing some of the good stuff that's happening.
Yeah, in the last last 2 weeks actually, the USO has gone from 80 to 90%. The June contract, it has zero in the June contract at this point, and they've basically pushed it out along the curve. And some of these other indices have they announced yesterday they were going to clean themselves out too, and so those were out selling today. So I don't think the financial issue is going to be a big issue now. You got to start looking at physical markets. And I'm telling you, the physical markets right now look like they're bottoming. That doesn't mean we're going to inflect higher, but things look marginally better, and that's a big change from consensus.
Colin Finton, what are you seeing?
Well, in the natural gas market, as you know, over the past few weeks, we've been waiting to see the managed money net position go from a short to a net long. And in the data that came out from the CFTC on Friday, we got it just barely, 227 contracts, but we'll call it a net long position. And just to refresh the memory, remember with the warm winter and the very heavy supply growth that we saw back in February, this market had the largest net short among hedge funds in 15 years at basically the 15-year low for price. So that's a pretty confident short. In the months that have intervened, we've begun to see that position hold, first short covering and now some fresh longs. And so whether we look at the producers, the consumers, swap dealers, or even managed money, basically everybody is now pushing towards the long position. We wouldn't necessarily characterize this as bullish yet, particularly with the spot price below $2 and some of the factors that Matt's going to talk about. But I would characterize it as neutral. And in this kind of environment, we'll take it.
Awesome. Matt, what's your take? We've got a little bit of slightly positive oil news, according to Mike, slightly positive natural gas news, according to Colin. What's the news, according to Matt?
Yeah, I think the theme on natural gas and what we've been talking to investors about over the last couple of months has really been driven by the negative view on oil going into the May-June timeframe. And really the big picture here is that as oil production gets curtailed, associated gas production will also fall off. And so to give you some context for the TPH research numbers, we are expecting about 3 million barrels of oil curtailed here going into May. And that is going to carry with it about 6.5 to 7 BCF a day of gas that gets shut in. So for the very near term, it does feel like we're going to start to see the market tighten up in the May timeframe. We could see another 10 to 20 cents of upside on the spot market. There isn't a demand concern emerging, though, as we go into the June and July timeframe. Two key things are happening. First, marketing arms of the LNG side of the equation are basically starting to pull back on loadings going into the international market. And that really has a lot to do with the weakness in the global LNG market itself. Second, we are seeing an increase in force majeure cargoes basically not making their way off of the market out of the U.S. And so in total, if you sum those numbers up, we're expecting about 4 to 5 BCF a day of demand loss in June, and potentially something north of that heading into July. So while we do see a constructive backdrop from a supply standpoint, we do think there is going to be a demand response. That likely keeps natural gas capped in the short term at about $2.25 to $2.50 as we head into the back half of the year. For 2021, I think the fundamentals are still very constructive. If you look at the structural supply declines we're seeing in the U.S., the market will be short natural gas. Really, as we think about the factors that will cap the natural gas market in 2021, it will still likely be demand driven. So two key things we'll be watching there. First and foremost, how much does the global LNG market clean up? And there's a lot of work to be done, especially given how high European storage levels are today. And secondly, we do think coal will start to take some share back as gas prices rally. So for 2021, we still are expecting a strong response on the price front, looking for a $2.75 to $3 curve. But a lot of that's starting to get priced into the market. And so there's going to be some roadmaps that we're going to need to walk through here before we get to that upside in 2021.
Mike, you were saying the natural gas production numbers are down. That just came out.
Yeah, from the end of last year until now, they're down about 4.5 and maybe closer to 5 Bs. But over the last week, they've really plunged, which kind of tells you what we expected, that crude oil production across these crude oil basins is actually falling. And I think what you're going to see is when the DOEs come out tomorrow, you're going to start to see some of that manifest itself through the DOE numbers. You're probably going to see production down 400,000 or 500,000 barrels, and it's just going to accelerate from there in the coming weeks.
Matt, before we leave the macro section, anything more on shut-ins and what we're seeing and what those numbers might be? Last week we were saying 750 going to 1 million here very quickly.
Yeah, we've seen, I think the Bakken has been the canary in the coal mine to some degree. It looks like the Bakken has probably shut in somewhere between 400 and 450,000 barrels a day. And that's on a base of about 1.4 million barrels. We do expect the pressure on the June curve to really accelerate announcements from the industry. We're heading into earnings here in the next 2 weeks, and so I think you'll see a lot more announcements coming out publicly around shut-ins. So as things stand today, we're seeing a clear sign of shut-ins accelerating, really coming out of the Bakken, but I think that's going to grow in a pretty meaningful way as we get into earnings and companies officially announce their plans over the next few months.
Okay, awesome. Matthew Belair, let's turn to you. Matthew hasn't been on the show with us yet. For those of you who don't know him, he is head of refining and chemicals research here at TPH, based in Denver. Matthew, we should call your segment Planes, Trains, and Automobiles, but maybe we'll call it Cars, Planes, and Capacity. Tell us what you're seeing in the data as you look at downstream activity.
Good stuff. Well, thanks for having me, Maynard. Maybe the best place to start is simply with product demand, which is just absolutely fallen off a cliff here. EIA showed single-week gasoline demand down 4.1 million barrels per day last week. That's a 44% drop. That matches up pretty well with some of our channel checks at retail stations. It also compares pretty well with the OPIS data that showed retail volumes down about 47%. To get a better handle on gasoline demand, we've created a custom index using TomTom GPS data. Our 40-city average here shows rush hour congestion at about 12% last week versus 59% last year. But there is some hope on the horizon. This index has improved modestly each of the past 2 weeks, and that's really been a function of gains in some of the large cities like New York and Los Angeles. On the jet side of things, conditions look even worse. Demand is off 1.2 million barrels per day, or 66%. However, similar to gasoline, some of the real-time indicators are showing some life. We track global flights. Those rose 9% week over week last week. We also track TSA passenger checks, and those rose 12% week over week. I'll wrap it up with distillate here. So, distillate demand is not immune to some of these conditions. Demand is off about 670,000 barrels per day, or 18%. I think that makes sense, given some of the recent declines in freight traffic as well as industrial production. But basically, if you just sum up these three categories, demand loss of about 6 million barrels a day, which is obviously quite significant.
Matthew, what about, we hear a lot about, crude storage. What about refined product storage? Is there anything in there worth commenting on?
That's an area to keep an eye on. It's not an area that we are particularly concerned about. In general, refiners have shown that they adapt pretty quickly to market conditions. And, just looking at some of the data, refinery utilization is down to 68%. That's tied for second lowest all time. And if you look at refinery yields of gasoline, they're off about 10 percentage points from year-ago levels. So in general, refineries can adapt very quickly to conditions. They can scale back quite a bit if cracks are poor. And compared to say like an E&P, deciding whether to shut in a well, that's a much more involved decision, much more significant decision compared to a refinery simply scaling back runs. So I think gasoline storage is something to keep an eye on. I think current gasoline storage is about 73% of total capacity, but in general, we don't have the same concerns on gasoline storage filling up as we do on crude storage filling up.
So Matthew, last question. When you talk to investors today about the refining space, what are the key questions they're asking you?
Well, in one sense, it's essentially become a pretty simple discussion, and it's just reverted to balance sheet strength. So in our group, we cover 8 refiners. I would say 4 refiners have pretty good balance sheets, net debt to cap on a consolidated basis in the 20 to 30% range. Those 4 refiners are ranked 1, 2, 3, and 5 on year-to-date stock performance. And the only reason that number 5 isn't a number 4 is simply because of some M&A rumors floating around. So, investors, they're focused on balance sheets. They're looking at book value as a valuation metric, which is pretty rare. Normally refiners are valued on EBITDA multiples or free cash flow yields. So yeah, in a sense, it's just becoming pretty simple, and it's focused on balance sheets, cash flow, and liquidity.
Okay, awesome. Thanks, Matthew. I think speaking of balance sheet repair or improvement, or what the doctor ordered, we've got Jason Wood with us. Jason's background is he was a longtime J.P. Morgan capital markets professional. He left to start his own firm, J. Wood Capital Advisors. He, like 2 other members of today's show, is a Princeton grad. He was actually a college friend of Colin Fenton. Jason, thanks for joining. All of us noticed a real bright spot in the markets last week when EQT did a convert. It was well received. It was upsized, and that was a breath of fresh air. Talk to us about the convert market, what drives it, and what you guys do at J. Wood Capital Advisors.
Sure, I'd be happy to. Thanks, Maynard, for having me on here. So just stepping back for a sec, the convert market is in very good shape and has been very healthy. So if we think about kind of overall issuance volumes, we look at common equity, they're down about 70%, high yields down about the same amount. The convert issuance in the last 4 weeks is actually up 3x from where it was last year. And a big part of that is the convert demand is there from investors. What helped in EQT, and I'll talk about the investor and then I can talk about what EQT was looking for. 70% of our issuance volume in converts is typically tech and healthcare. We haven't had an energy deal all year. And so this is a diversifying different investment for them. And it was really well received. As you said or alluded to, the demand was really good. We were able to upsize. In fact, we upsized from a base of about 350 or from 350 to all in at 500 million. And we priced near the company friendly end of the zone with a 1 3/4 coupon. And then with something called a call spread, the company has no equity dilution until the stock is up 50%.
And Jason, we heard all the lead in, you heard all the lead in and the macro discussion around natural gas, the excitement around natural gas. How much does that, I think of convert investors as being technical investors, not fundamental investors. How much of what's going on in the natural gas market has to do with EQT being able to get terms like that?
So it was a little bit of a mix. It certainly helped. With EQT, we were able to get sort of 3 pockets of investors. We had convert hedge funds, the ARB guys, who, as you said, are really technical in nature and aren't as interested in just kind of the overall story. We also had significant demand from the outright long-only investors in our space. In fact, most of the top 10 anchor orders came from those investors. Then we also had crossover investors from the high yield market. In the group call, we had probably 40 investors from high yield on that, and they participated in a pretty meaningful manner. So I would say all of that together really helped drive the pricing for EQT.
And Jason, what would you say? I think a lot of us on the call here and in the audience, been around converts in the past, and there's that old adage about converts. They're debt when you want them to be equity, and they're equity when you want them to be debt, and they're complicated. And research analysts like Matt and Matthew have a hard time calculating things. How do you think about the product along those lines?
So I agree they are complicated. It does take some time to decode and go through the economics and then the associated accounting and the tax. Having said that, once you go through it, and in particular in the market we're in, they can make a lot of sense. So if we just kind of look at it through EQT's eyes here, they did $1 billion of high yield in January at 6 1/8 coupon. Fast forward to last week, and their high yield rates were in the ballpark of 10%. Right, so the high yield market has had significant dislocation, and its rates have jumped pretty dramatically, while the convert coupon hasn't changed much. So the delta or the difference between where they can fund in the high yield market, which is now like 10%, versus what we got in the market last week of 1 3/4, just means it can be really compelling from an economic perspective. And then the other thing I oftentimes hear is, well, yeah, but you have dilution. So if the stock goes up, it's going to cost me more in the back end. And this was a really important thing we did, where the company turned, and we designed this for them. They purchased a hedge on their shares. So even though the convert is only a 20% conversion premium to the close last week, so the company suffers dilution at $15 a share. With the call spread, that goes up 50%. And so when you put it all together, they're paying a really low coupon of 1 3/4. They have no dilution until the stock is up 50%. And even when you include all the costs from this hedge, it's still less than 3% money up 50. No financial covenants, very flexible, and with a market that's really supportive.
So Jason, maybe as we wrap up with you, I think people would love to learn a little bit more about your firm, your team, and what you do when a company calls you in.
Sure. So we do really only one thing in life. We help companies with convertible debt. And so we help from the beginning of understanding the structure and the economics. And we say the most important thing we have is information, and we share it with companies so they can make a better, more informed decision. So we really sit on their side of the table and just go through all of these decision points to try to find a path that can make sense for them in this market. Now, again, it's not for everyone, but it is a really good option, particularly in volatile times. And I think our team is really good about coming in an unbiased educational way to say, here's the art of the possible.
Fantastic. Well, look, thanks so much for joining us, and congrats on that offering last week. I think as we wrap up, we were going to turn to Bobby Tudor, our chairman here at TPH and also the chair of the Greater Houston Partnership. Bobby, you and I touched on this earlier. You've been a part of so many of the discussions in Houston as we've been preparing for whatever was coming. You've been part of more recent conversations about perhaps reopening, all the debates that are happening. What would you tell us about what's going on amongst business and government and in the planning circles right now?
Well, the job of the Greater Houston Partnership is to be the voice of business and policy making with both local and state and federal officials for that matter. And so our role has been to be really engaged and making sure that the business community is being heard when it comes to policy related decisions. There are a bunch of very important ones to be made, obviously, as it regards this COVID crisis. And in the beginning, it was really important that the business community be seen as being supportive of a fairly, draconian action from a political point of view when it came to effectively shutting down the economy. Now, given that we've had really pretty good success here in Houston and in Texas more broadly with regard to our ability to contain the virus, and I'll speak to that in just a second, kind of the whole conversation has now shifted more to, okay, how do we begin to reopen the economy in a slow, methodical, and effective way without risking another real spike in infections? So just to put some numbers around this, we've had about 8,300 confirmed cases of COVID in Greater Houston. That's the 9-county area, and we've had just under 200 deaths. Now, that number of confirmed cases can be a little misleading because we haven't had broad testing yet, and our assumption is as testing gets broader and goes up, the number of confirmed cases will go up. But this death by COVID number is a really important number, and the fact that we've had less than 200 in a metropolitan area of greater than 7 million people means that our mortality rate here in Houston has been very low. And it's really that's given us the confidence and kind of the shape of confirmed new cases that's given us the confidence to think about beginning to open the economy back up more. So we actually, in the last 2 days, have had our first 2 days of less than 200 confirmed cases a day. And so that's really good news in Houston. So then the question becomes, well, what do you do about it? And early on, you have to remember, number one, that relative to most major metropolitan areas, Houston has a higher percentage of its total business community that was deemed an essential business because energy basically anything energy related got a massive carve out. So our refineries and manufacturing facilities and processing plants and everything on the ship channel, all of that's actually been working. And so the percentage of our total kind of workforce that's been working over this period of time has been higher than in most other metropolitan areas. That being said, we've had major shutdowns in broad swaths of the economy, as everyone knows. Early on, the Texas governor had really kind of ceded to local authorities the ability to put out orders that would, in effect, regulate what was going on either at the county level or the city level. More recently, just this week, Governor Abbott in Texas has now had his own executive order, and those executive orders trump all county and local orders. And what he's done effectively is start to loosen the screws a little bit, and just a little bit, so that we can start heading towards a slightly more open and vibrant economy. I think importantly, the core message actually is still what it's been, which is that we want to generally avoid all unessential activity as much as we can. We want to avoid social interaction with people outside of our immediate family as much as we can. But at the same time, we want to begin to kind of unscrew the bottle top a little bit so that some businesses like restaurants, for example, and retail can start to go back to work, albeit on a limited basis. The idea is that in a couple of weeks, he likely will issue another order that will either expand or contract those freedoms, kind of depending on what we see across Texas as it regards our continued control of the virus. So we're going to take it kind of a few weeks at a time. We'll know more on May 15th. In the meantime, the economy will come slightly more open, but with high levels of cautiousness is the way I would describe it.
So, Bobby, as we wrap up, I know the partnership, you guys work a lot with the Med Centers, a lot of great coordination and communication with them. What do you hear out of the Med Center on the extent of things from their perspective?
Well, the Med Center is pleased with where we are in the sense that we never edged into really desperate straits as regards available ICU beds, available ventilators, et cetera. We've remained well below our total capacity there. We got out in front of it. And I think we've been lucky in many ways. Obviously, our community was not as broadly penetrated with the virus by the time we went on lockdown, but we went on lockdown pretty aggressively and pretty early. And we've had great advice from the leaders of the Texas Medical Center around that. I would say they are absolutely supportive of us planning for and beginning to kind of unscrew the bottle cap, as we say. Yet at the same time, they want to make sure that we don't unscrew it too quickly and get faced with a real spike in incremental infections that will result in further lockdown in the way that has happened, for example, in Singapore and more recently in Tokyo. So we're very much kind of on the lookout for recurrent spikes, and we want to make sure we're on top of all that. And at the same time, we want to allow our hospital system to serve all the patients that it needs to serve, most of whom don't have COVID. And so one of the things that's happened is that the hospitals have not had elective surgeries, for example, at all over this period of time. And they're going to begin to do some of that too. So we've had great leadership from our medical community. They've been highly integrated with the business community via the Greater Houston Partnership. And we feel good about where we are right now, realizing that all that could change, and it could change in a negative way quite quickly. So we just got to stay on top of it.
Well, look, I think as I survey what we learned here today, we heard a little bit of, Mike, you were talking about oil fundamentals. Colin was talking about more longs than shorts in gas. Matt had a little bit of good gas news. Jason pulled a whopping $500 million out of the world for an oil and gas company last week. Matt, Blair, you've got some increased driving and flying activity, and Bobby's got some pretty good news to report. So we should stop talking immediately. But anyway, thanks everybody for joining today. Really appreciate the conversation. Thanks to all of you out there, and we'll see you next week.